The key to success in investing is by doing it smart and sticking to some key investing principles. Intelligence, initiative, and integrity are some of the factors that make investing a success. In this video, we will discuss the 6 principles that you need to follow when starting to invest, according to the world's greatest investor, Warren Buffett. So watch this video until the end, hit the like button, click that notification bell, and subscribe. Welcome back to 3 Towers Investing Channel. Number 1. Invest by facts, not by emotions. Investors act in very human ways, such as being ecstatic during bull markets and looking in the rear-view mirror. And when they look back in the rear-view mirror and realize how much money has been earned in the past several years, they rush in and continue to raise prices. When they look in the rear-view mirror and realize no money has been earned, they just dismiss the situation as a bad one, and they don't care what happens in the underlying firm. However, this presents a big opportunity. Number 2. Buy wonderful businesses, not cigar butts. We've been trained to buy goods quantitatively, to hunt for bargains, and to refer to discarded cigar butts on stocks as such. And the cigar butt strategy to stock investing is that you stroll down the street hunting for cigarette butts and you come across this. Obviously, there's one puff left in this horrible looking, wet, ugly looking cigar. But you pick it up and take it. You toss it away because it's disgusting. But it's free, or at least inexpensive. And you're on the hunt for another soggy, one puff cigarette. That is, after all, what others are doing. It's a blunder. You can earn money doing that, but not with a lot of money. It's far simpler to just purchase fantastic firms. Rather than buying worn cigar butts of stocks, invest in a good firm at a reasonable price. Number 3. Only buy stocks that you understand. We have an old assumption that we can only hope to profit from what we understand. When we say understand, we're looking at how the business finances will look like in 10 or 20 years. Evaluating a business should be within your capabilities. Understand what businesses do, how they make money, and how they compete in the market. Number 4. When you see a great opportunity, take it. The biggest mistakes are mistakes of omission and not commission. It's the things we knew enough to do and within our circle of competence, but we didn't take the opportunity. However, omission is far more serious than commission. Big possibilities in life must be taken advantage of. We don't do a lot of things, but when the opportunity arises to do something important and good, we must take it. And doing it on a small scale is almost as bad a mistake as not doing it at all. You're not gonna get 500 wonderful chances in life. Number 5. Don't sell unless the business fundamentally changes. Don't sell your completely owned enterprises, no matter how much someone offers. If we were always short on cash and all kinds of chances presented themselves, we could take a different approach. But we have a strong aversion to selling things unless we are dissatisfied with the management or believe the business economic features are changing dramatically, which does happen. So we're not going to sell just because it appears to be too expensive. In all likelihood, you won't be able to make that 100%. Number 6. Buy at a price below intrinsic value. Intrinsic value is the value that you would be paid if you knew everything about the future and could forecast how much money the company will provide you between now and Judgment Day, discounted at the appropriate rate. That figure represents a company's inherent value. To put it another way, the only purpose to invest and save money now is to obtain more money later. That is the essence of investing. So calculating the value of a bond is simple. Nevertheless, the value of a bond can vary tomorrow if interest rates change. Would you lay out your money now to receive what the Coca-Cola company is going to provide to you if you bought Coca-Cola today? And that is a matter of how much money they will provide you. It's not an issue of how many experts will endorse it, or what stock's volume is, or what the chart looks like, or anything else. It's all about how much money you're going to get. And the question is, how much will you get? When will you get it? And how sure will you be? And when we evaluate a business intrinsic worth, when we acquire businesses, whether we're buying the whole thing or just a portion of it, we always assume we're buying the whole thing because that's how we approach it. Examine it and ask yourself, what will come of this business and when? And of course, you want them to be able to put the money they make to good use and generate better returns as time goes on.
Just being born in the United States in 1930, the odds were like 30-1 against me. I mean, I didn't have anything to do with picking the United States as I emerged, and having decent genes for certain things. And in my own case, I was sort of wired for capital allocation. And being wired for capital allocation a couple hundred years ago in Nebraska wouldn't have been a thing. And even now, being born in various parts of the world, it wouldn't have meant much. But here I was in this soon-to-be very rich capitalistic system, and it just so happened that what I did paid off enormously in a market system like we have. And if I'd had a talent in some other area that was way less commercial, I mean, I would have had a good time doing it, but it wouldn't have paid off like this. But of course, Jay said it perfectly when he talked about, he's in there recording for himself, and the money comes afterwards. I mean, I got to do what I love. I mean, and it doesn't get any luckier than that. If you can spend your lifetime, and I'm 80 now, and doing things you love every single day. I mean, I would be doing what I do now, and I would have done it in the past, if the payoff had been in seashells or shark's teeth or anything else. If you can go to work every morning, I tap dance to work, and I come down, and every day's exciting. So that is lucky. I mean, that didn't have to happen that way. If I'd been born in 1930, if I'd been born a female, if I'd been born black, I would not have had the same opportunities that I had. I mean, it's chance. I mean, my parents loved my sisters just as much as they loved me. My sisters are just as smarter than I am and all of that, but they didn't have the same expectations in the 30s for a young smart girl as they had for a young smart guy. And so I've had all kinds of luck. I had the luck of, I got turned down by Harvard. Well, getting turned down by Harvard meant I got to study under Ben Graham at Columbia, which changed my life. All kinds of things have worked out. So I just hope I stay lucky. I've been lucky for 80 years.
It's ironic that Warren Buffett's simple ideas, if followed over time, provide such a large return. But that's the difficult part, which only a few investors are capable of. Remaining reasonable while adhering to these standards and not submitting to our emotions. Few will be able to attain so, but those who can will be rewarded generously. I hope you liked this video, and if you do, please don't forget to hit the like button, subscribe, and share. Once again, this is your Three Towers Investing channel, giving you the latest in finance, investment, and innovation. Thank you for watching, and see you in the next video.